Hi, I'm Adrienne Ashley with Wow Is Me, and I know you're probably wondering, why is someone who focuses on marketing and PR and the media and raising visibility and platform for clients talking about mortgage modifications? Well, I'm talking about it because what we do at Wow Is Me is a holistic approach. It is not just about how you're perceived in the marketplace. It's also how you manage your business, how you formed your business, what your foundation looks like. And when 1 in 10 Americans, homeowners, are in distress or in default, and it's looking like a lot more are going to be in trouble, I thought it might be a good time to explain why and what the recipe of mortgage modifications is and what we're asking them to do, just so you understand a little bit more the landscape that we're all operating in. So the problem, well, the question really is, out of all the mortgage loan modification applications submitted, why have only 1% been approved so far? And I was trying to explain to a client this the other day, and I realized if I give you the exact terminology and the banking words and how they set it up and how they divided everything up and moved this and moved that, you're going to get really confused. So I had to come up with an analogy that everybody would understand. So we're going to be talking about baking a cake. We'll be using flan because flan is made of eggs. And for this particular demonstration, eggs suit my purpose perfectly. So we have eggs. Every single one of those eggs is a 30-year fixed loan. These little white eggs, they're all similar, they're all the same, they're straight A paper mortgages. This is what the bank used to lend on. Now, every single one of these eggs is pretty much replaceable with any other of these eggs. They're all identical. Very cookie cutter, very easy, very simple to predict the risk, very easy to package up. But profits were better when they added in a few different types of mortgage products to the mix. They found if they went a little lower on the credit score, those people would pay more in interest rate. If they went a little higher on the loan amount, those people would pay a little more on the interest rate. If they used adjustable rate loans with a low teaser rate that would adjust and go up later, those people would end up paying more for those loans. These were more profitable loans than a straight 30-year fixed. Still, not too bad. Fairly semi-homogeneous, doesn't look like too much risk. Then they added no documentation loans. Now we see we're getting a little bit more exotic here, especially when it comes to our recipe. So when we're talking about what they did with all of these loans, we'll get to that when you see what I'm talking about, but think about these are the ingredients. Subprime loans. Lots and lots of subprime loans. As far as the eye can see, this was a humongous cash cow. Now I want you to keep in mind that when it came to subprime loans, when you're talking about a 580 credit score, you're talking about someone who has an 80% risk of default. But when they calculated the profits on these subprime loans, when they projected it out as if it were a full pay for 30 years and counted all that profit, even though 80% of those loans they knew, based on credit score alone, were not going to make it. Then we have stated income loans, called in the industry liar loans, because you pretty much put anything down, picked a reasonable title, and as long as you could match it up online that somebody was offering that amount of money for that particular job title, you got your loan. Now we have ninja loans. No income, no job, no assets. Pretty much a signature loan for $1 million house. And yes, you could get a ninja loan with a high enough credit score. You could get a $1 million loan with your signature. So what did we do? Well, I didn't do it, but the banks take all of those eggs as their ingredients and put them together in what's called pooling agreements. Because you have to understand, a bank has to have and can only borrow from the federal government 10 times the amount of money that it's holding in deposits. So it needs to recoup this money that it's giving out in loans. Otherwise, it can't make more loans. So how do you recoup the loans? You can't turn around and then sell the loan, then you're not making the money off the loan because you've sold it. So that's only a one-time thing, and they wanted to make recurring money on these loans. So what they did was they transformed them. Just like you take all of your basic ingredients and bake a cake, you transform it from single ingredients into a cake. You with me so far? Then they put them into a shell called a security. Just like we're putting it into a pie form here. We're baking a cake. They put it through the legal process, through the SEC, and voila, transform it into a trust, into certificates, and sold them to the banking customers. So if you went to Washington Mutual and you took out a mortgage, it was nearly instantaneously, every few days or so, at least once a month, transformed into a pool, $68,685,000,000, hundreds of millions of dollars into these certificates. All of these mortgages put together, whisked up, created into a single entity, and then sold in tiny little bits and pieces, like every single bite, every single fraction of a bite was sold to somebody else. You with me so far? All of the eggs, whisked up, transformed it into something else, sliced up, and sold back to the customers. Now there are class action lawsuits against some of these banks, especially Washington Mutual, that said that they had steering agreements for their financial services reps that paid them more commission to steer their customers into buying these certificates so that the bank could make more loans. Now it's all gone. It's all been sold because they needed to raise the money to buy more eggs, to make more loans. But the question, what we're asking them to do when we ask them to make a mortgage modification, we're asking them to go back and replace our egg. That egg has already been broken, it's already been used, it's already been baked, it's already been made into a cake, it's already been sliced, diced, and sold. There is no point at which you can identify every molecule of your original egg and put it back in the shell and replace it with a different egg. This is what they won't explain it to you. They can't undo it. They can't put Humpty Dumpty back together again. The eggshell is cracked, the innards are gone, they're sold off. All you're left with is the shell. There are things you can do. We're not going to go into them on this webinar. I just wanted to explain to you what it is you're asking them to do when you want a mortgage modification. The problem is you can't refi because there are no products out there for most people who are having any kind of distress. There just aren't loans available. So we ask them to make a modification. And they don't tell you, they're not upfront with you, and they don't say, it's virtually impossible. I can't put the egg back together. I'm Adrienne Ashley. I look forward to your questions. Call us anytime, 415-287-0075, or visit us online at wowisme.net.